point that inflation cooling, actually peaking, would be bad for stocks, good for bonds. You said something last week that I've been thinking about since. You said that you want to be in cash first, then you want to buy treasuries, then credit, and buy equities last. Where are we on that time frame? Should we be buying duration here?
That's exactly right. So we've been adding duration in our portfolios really since the summer, probably a little earlier than we should have. But we try to be a little bit ahead of the game. So yes, front end cash, short duration was the first place to go for safety because it was a bear market for bonds and stocks. But then bond yields reached an attractive level, we thought, this summer, and of course we exceeded that. We got to 4.25 on a 10-year. And now we've come back to 350. So it's obviously not as good a value as it was a month ago, but it's still a better place to be if we're going to be right about the earnings cycle. And then investment grade credit, also offers a pretty good place to be as long as you're high, on the credit quality side, and you're probably not, 5 to 7 years is kind of your duration there. And then yes, equities are last. Now within equities, we've been positioned all year in sort of the defensive sectors, which are basically bond proxies, right? So that's why we've outperformed so much this year in our portfolios, because we basically made that shift. Even within our equity books, you can be defensive, and that's what the market likes right now.
So as part of that defensive-ness there, I mean, I remember, we had the big debate, I think, late last year and earlier in this year between value versus growth, momentum, and some of the other kind of major pure factors here. Is that an argument, or is that a debate that I guess is realistic to the conditions that we're in right now? Is that sort of a separation between value, growth, and the stocks that represent those, or is it just kind of a mashup right now?
It's more of the mashup, unfortunately, because the problem with the value stocks now is that they're probably just as vulnerable to, the economic slowdown as the kind of over-earning growth stocks were 6 or 12 months ago. So I don't think there's as much of a distinction between value and growth at this stage of the economic cycle, unless you're talking about the defensive parts of value. For example, utilities and staples and healthcare. Those are value sectors, but they're not the kind of value sectors that people normally think about when they say, I want to buy value. Normally, you're thinking about industrials and financials and energy and commodities, and that's probably not the place you want to be at this stage.